Welcome to PSG Asset Management with me, Joanne Bainham, independent moderator. Today I'm joined by Philipp Wörz, and we're going to be talking about global multi-asset and global equities. So thanks for being here, and thanks for chatting to me.
Hi, Joanne. Nice to see you.
If I buy your fund now, am I still going to do well?
Look, the reality is we've come off a really extreme period in markets. I mean, you look back, I think, pre-COVID, we were kind of at the extreme ends of what we thought was a real bubble in generational low interest rates, sky-high valuations in some parts of the market. And the last few years have just seen that regime changing slowly. We've been discussing that for quite some time, there's big divergences in market valuations. But if you look at the markets today and going forward, and I think it's a really good question what you're asking, the reality is global markets are trading at reasonably elevated levels compared to history, but also in absolute terms, which doesn't get us too excited. But if you look at our investment process, and you'd be aware, we look for opportunities in areas of fear and uncertainty. That generally leads to depressed prices, but also areas that are uncrowded. And we're still really finding incredible opportunities. So when we're looking at our funds today, for example, the valuation of the equities in our funds are trading at about 0.6 times price to intrinsic value. And even that's still at about a 20% discount to its longer-term average.
So you didn't change your philosophy because the market's changed. You stuck to your knitting, is what you're saying. And now finally, the market's probably coming more around to your way of thinking. So you've still got a long runway. Is that what I'm hearing?
The positioning of the market and of market participants, I think people generally, people like to extrapolate the past. I mean, you know this whole story of recency bias. And I think if you're looking at the sectors and stocks that really did well and outperformed over the past decade, it's no surprise that people are still sticking to the winners of the past. Mm-hmm. If you look at our process, and I think that's where we think we've got a competitive advantage, we are benchmark agnostic in how we construct portfolios. And as opposed to rather focusing on where the puck has been, we're looking where the market environment is evolving to, and we're finding amazing opportunities in areas that aren't necessarily massive in the index and in most other investors' portfolios.
Okay, so I'm sure there's a criticism being thrown at you guys before that why on earth would I give money to a team based in South Africa when I can invest with the best global minds in the world sitting in London, sitting in New York? Why? Sure. What gives you the edge? Because surely it can't be an information edge. Yeah. I mean, you're a smaller team. You are. So yeah. What's your edge?
Look, it's also a fair question. It's one, obviously, that people need to ask. People that know PSG Asset Management, you would know that we've got a long-term track record of alpha generation in our local funds. Now, the key question which you're asking is, how do you do this globally, especially in an environment where the universe is significantly larger than the South African environment? Now, we've been investing globally for 15 years, so since 2008. And I think one big change in the last decade, and it's even accelerated since COVID, has been that technology has really changed the game in terms of accessing information. Not just technology, but also regulation in terms of getting access to that information. So we think there's no longer any advantage whether you're sitting in London, Boston, or Cape Town. Additionally, we do have a team of 20 investment professionals most of us have been together for a long period of time, where we've got a team-based decision-making process, where we're looking into those uncrowded areas. And we think global is actually really well suited to that.
Okay, so part of that tailwinds, so to speak, is because we've come out of an environment of zero interest rates, and that's largely been a big driver of growth shares. You, as a house, don't tend to overpay for assets, and that's kind of momentum investing is what's been really popular. Why do you think interest rates are going higher? What is this regime change all about that you think we might have higher interest rates for longer, higher inflation for longer? Give me more color as to why do you think we're changing?
No, sure. Look, the reality is interest rates have been pretty much zero globally for quite a long time. And many assets were starting to be priced off that. And that's why you saw those bubbles in the 2019-2020 period. People that have followed us for a while, we've been discussing the underinvestment in the real economy for quite a while. So that's examples such as the energy sector, where in 2014, 2015, you saw a crash in oil prices and a subsequent declining capex spend. Similar story going on in the natural resource sector, where people kind of saw this China super cycle in the in the mid-2000s into 2010 and overinvested into capacity there, that led to oversupply in those parts of the market and subsequent price declines. Now you've seen in the last 8 years, arguably, you've seen the whole industry and those types of industries underinvesting in capacity. Additionally, what we're seeing at the moment, and it's been coming for quite a few years, this kind of decoupling of the West from the East to some extent. And it's really a case that people can probably no longer rely on supply chains out of the East and cheaper labor.
Wasn't that the just in time became just in case?
I
think that kind of changed supply chains, didn't it?
As people tend to probably go to two extremes, and we'll probably see a kind of an overshoot on the other side. So some of those factors, coupled with pretty tight labor markets in developing countries, and even in aging populations in most major countries, just leads us to believe that conditions will be different to those people we're kind of used to for many decades in the past.
How do you cope as managers, given your regime change, given your longer term view, given that you're looking at these areas that people are not looking at? How do you cope from an emotional, behavioral aspect during times like this?
Sure. So I think the emotional aspect and behavioral, I think it's actually one of our strengths at PSG Asset Management. I think we've shown the temperament to look for opportunities in areas of fear and uncertainty, and have demonstrated it through various crises in the past. I think you raise an important point. People, the kind of forecasting pundits, things hardly ever turn out the way people kind of expect it to. And I think one needs to be honest and pragmatic that you've got to construct your portfolios to many different outcomes. But I think it's also a case that the way the market's structured, in that people are still holding on to that environment of the past, any reason to reflate those assets that have done well historically are kind of being grabbed onto. I mean, obviously, there's been some shorter-term tactical factors that led to some of the moves most recently. But even in that environment, year to date, the funds have held their own. We don't try to forecast what asset prices are going to do next month. But also a couple of our stocks, we've had a good year last year. I think there's been also just the same reasons as people looked for reflating other assets. There've been reasons for selling off some of those more recent performers. So yeah, it's an interesting environment we're going through. But I think the one thing we can be reasonably sure of, while we can't really forecast demand or whether a recession will come in the third quarter, etc. Going back to that underinvestment in the real economy, those lead times are not just 6 months, they're multi-years. And in the case of building real capacity, really talking decarbonization, electrification, these are decade-long investments, and those things aren't going away. So that tightness leading to what we think is structurally higher inflation will sustain for quite some time.
Okay, so we talked a lot about the regime change type concepts. One of the very more topical things in markets in the last couple of months, years, has been the rise of China and the relationship between China and the US sort of dismantling, for want of a better word. How do you think about risk when it comes to investing in Chinese equities within your global portfolios?
Yeah, I think the way we think about risk, and it's a really difficult question actually because it's quite complex. The way we thought about risk in China, it's got nothing to do with the recent dismantling. I think it's been more a case of we've in our process, part of our 3M, so the mode management, margin of safety, management and margin of safety is obviously a critical element. But looking at governance, we've got a high hurdle to invest into Chinese equities, given certain opaque structures in China, whether in some companies, whether it's variable interest entities, or whether it's the CCP sitting on boards. It's just things need to be very compelling for us to invest in China, which has nothing to do with the more recent fears about Taiwan and some of the other geopolitical factors we're going through. So obviously there are indirect exposures to China that we have. China is still a big customer of many commodities. And also one of our big holdings, actually Prudential, which is listed in London, is the second largest life insurance company outside of China in the region, with an enormous long-term runway of growth ahead of them. So we prefer to de-risk our Chinese investments by not investing directly into China.
So I guess you're buying companies where the rule of law is more sacrosanct, potentially, and not listed in China per se. Is that what you're saying?
Absolutely.
Okay.
And we obviously got to be looking at it in a whole portfolio context as well. Like China's not going away. The population kind of GDP per capita will keep on increasing most likely for a long period of time. And there's a big prize to be had, but we just need to ensure ourselves and for our clients that we're going to get that capital back.
I think you're the first manager I've spoken to for a long time that actually looks at management issues around China, because it's quite amusing to me how many ESG funds buy China, but then they don't look at the massive ESG, government risk and the kind of ethics, but that's the story for another day. So you've talked a lot about regime change and talked about underinvestment and geopolitical risk perhaps. That kind of covers the resources, energy stocks. Are there any kind of more, would you be investing in biotech? Are you investing in AI companies? Are you investing in US tech? Are there some US tech gems now that are looking interesting? Because I don't think you're completely anti-growth. You just want to buy growth at the right price. Yeah. So are there any other areas of the market within that 40 portfolio that's outside the regime change, and what are they?
Yeah, I think you're quite right. We love growth. We just don't want to overpay for growth. If you're asking tech, the tech sector was actually the largest sector in 2015, 2016. When that part of the market was out of favor, the fund had large holdings in the likes of Microsoft and Apple, for example, Cisco. It almost seems a lifetime ago when those stocks were trading at a P ratio of sub 10 times, and close to today, I think they're close to 25 to 30 times, as an example. So we're not anti that sector as a start. If you look at our portfolio, I think it's important to stress it's not just investing into energy and resources, as attractive as it is. The largest part of our portfolio is actually in a bucket which we call, which is really our 3M kind of classic opportunities. Those are underappreciated quality companies. They've have a good track record of growth over the long term, but temporary issues, in our view, are depressing share prices and giving us opportunities in that space. So we think the opportunity set there will really be from earnings growth returning and the market paying more attention to that going forward. Some examples would be the likes of Anheuser-Busch, which is the largest brewer globally, Asahi, which is a Japanese brewer with big investments in Australia and Eastern Europe. We've got a discount retailer that's growing at high rates in Europe called Pepco. We've got a company listed in the US but operating in Europe called Liberty Global.
For the first time in years, I'm hearing people buying US treasuries again in portfolios.
Yeah.
The high yield bond market is interesting or not overseas. So perhaps just moving away from equities for just for a few minutes, and your multi-asset products, how are you thinking about global bonds right now?
So the multi-asset product is the PSG Global Flexible Fund. The Global Flexible Fund, our default option generally has been, if we're finding good equity opportunities, we're going to be buying stocks. Mm-hmm. And if we don't, we're going to be sitting in cash. Mm-hmm. So historically, obviously, global cash giving you, let's call it zero returns, there weren't really many alternatives. Additionally, credit spreads were tight. So it's really been a case of bonds of cash and equities. As you rightly say, finally, we're getting some yield again in treasuries. So part of our cash holding is sitting in short-dated US treasuries. We're still not really willing to go down the curve in that space. On a credit perspective, we currently don't own global credit in the Global Flexible Fund, but it is an area where we're looking to sharpen our pencils when yields or when spreads kind of are sufficiently compensating us for the risk.
Philipp, thank you very much. I enjoyed our chat today. Thank you.
Thank you. Appreciate it.